we never look at traction as like a core deciding factor for whether we're investing in the business.
Oh, really?
It's really about, I actually think like traction is extremely overrated.
That's like the number one qualifier for most people, isn't it? Most investors.
I think here's the reason why. If you are a strong founder, you can actually fake product market fit.
So you can fake traction going up?
Yeah. Like if I were starting a company tomorrow, like could I call up a bunch of insurance customers that have worked and be like, hey, give me a 6-figure contract. I'll do some of this stuff. And I'm like, I kind of did that during business school. Like I had a startup that I was able to go and get enough traction for that like we could, had actually like, some serious ARR. Now, was that company actually a good company? No, it was terrible. Like, it was awful. Like, I don't even put it on my LinkedIn because I'm so embarrassed by it. That like the reality was, it was like, we were basically like a software dev shop, and it wasn't real. Did we have product market fit? No. Like it was a, side project that I did, like for business school credits that like somehow magically stumbled into some revenue. Like, and, so as I think about that, like if you're a good salesperson, you can fake product market fit. You can at least achieve, some level of what investors would consider from a metric basis. Yeah. I think the more important thing is finding your path to moat. And that's actually the thing that we focus on. Like when we're working with a company, like it's not how do we get you to $1 million of ARR? It's how can we get you to that first demonstration of that you have a moat over the competition.
Welcome to The Peel, where we explore the world's greatest startup stories. I'm your host, Turner Novak, founder of Banana Capital. Today's guest is Rick Zullo, founder of Equal Ventures. Our conversation gets at Equal's unique approach to venture capital, thinking more like public market and private equity investors, and why traction is overrated at seed.
Two of the best businesses that we're in today were basically flat for multiple years when we invested. If I'm looking at your CAC LTV ratios, as a seed stage investor, I'm doing it wrong.
We also talked through Equal's thesis-driven model, employing a team of product owners, only investing in 3 to 5 themes at once, and Rick's admiration of Charlie Munger.
I know very little about actual technology.
We get into who will benefit the most from AI.
I actually think in private equity and in service businesses, they will make way more money than venture capitalists make in total revenue from those companies. You want to find markets that are structurally enable, captivity to happen over customers, and then find ways to actually lean in on the core competencies of the business to reinforce that and make sure that you have some compounding advantages.
Why venture capital is not really venture capital anymore.
It shouldn't take $150 million for every single vertical SaaS company to get to profitability.
Why it sucks to be a seed investor right now.
So it's become literally 80% less attractive to be a seed investor since 2021.
Rick's advice for emerging fund managers and why talent is leaving the mega funds.
Hey, if that person had led investment and then left a month later, like that probably would have killed one of our companies.
And his struggle raising Equal Fund 1.
It was so bad that my friend was like, you need to shut down your process right now and figure your shit out.
A quick thank you to Atul Rusky, Joe Floyd, Max Oxier, and Ali Afridi and Chelsea Zhang at Equal for help brainstorming topics for Rick. A reminder, I publish 2 episodes of The Peel every week, exploring the world's greatest startup stories, just like this one. Let's talk to Rick.
Rick, welcome to the show.
Thanks for having me.
So excited to have you. We're going to talk about a lot of different things. One of the ones I'm really excited to talk about, you feel like venture is sort of not venture. So this asset class we all work in, venture capital, you feel like it's not really venture capital anymore. What's going on?
I think if you look at where venture was 10 years ago when I broke into venture in business school in 2012, 2013, and you were thinking about seed rounds for $1 million checks. You were thinking about if you had $1 billion exit, that was kind of considered like a
insane, great
thing. Yeah. I remember the first $100 million fund or first $1 billion fund and thinking, wow, like venture is becoming real money. NEA was the biggest venture fund back then, and now as you think of where venture funds are and some of the news that we've seen from Andreessen, Sequoia, Lightspeed, Insight, General Catalyst, like it's become a completely different mechanism. That as I look at the companies that you can fund, as well as the outcomes that you need to achieve, the size of funds, like if someone told me 10 years ago that we'd be managing $250 million, I'd be like, you're high. There's no chance that's actually ever happening.
Like you would assume you were like the biggest player in the space, like biggest, most AUM of any like early stage New York fund.
When I started working at Lightbank, I think first round was one of the bigger like seed funds, and they had 100. And I look at guys like Roger Ehrenberg, and their first fund was 55 million, and that was like a very big time fund. And now, like to a certain degree, if you're not playing with 100, 200 million dollars, you're subscale, for being able to lead rounds. That's even at seed stage. So I think the game's changed in a lot of different ways, and part of that is the amount of AUM that's come into the ecosystem and some of the impacts that has on it, and some of the incentives that it brings. And we can definitely talk more about that. But a big part of it's also what's happening on the company side and how investors are looking at this. And I think by and large, a company like HubSpot probably couldn't get funded in today's, environment. Hey, we're going to build SMB marketing software. People would just say like, too crowded of a landscape. Like, there's not really a way to go and, get excited about the size of that company, the total TAM. That's a $40 billion company. Like, I'd be very happy to be an investor in that. I think when public at around $1.5 billion, a lot of what we're doing now is either lottery ticket chasing, or infrastructure investing, i.e. planning to put $1 billion to work to get something that's going to yield maybe like a 10 to 15% IRR. And I think that's fundamentally different than like the true art of venture investing, which actually increasingly fewer firms are doing that.
So can you even do venture investing in today's environment?
Yeah, I think that there is, but the reality is you got to think about how you're going to play that game and make sure that you can achieve the outcomes that you want to achieve without being fully reliant on the downstream capital that's in the ecosystem. So we did a post for our LPs. We don't share everything that we write externally, called offense and defense. And the way that we were thinking about is, hey, there's going to be positions that like we want to go and own as much as this company as possible. Like this company is achieving profitability early. We want to get them off the big venture machine as fast as possible. And we just did that on one of our companies that went from, roughly 1 to 10 million in 2 years. It's profitable. Company that we love. We plowed into it, because they didn't need a 30 to $50 million round. We now own north of 20% of that company. And we think it's going to be a massive outcome for us, but they don't need to get onto the traditional venture capital train. It's very likely actually the next set of investors that come into that company, could be Temasek or Blackstone or Ares or Apollo, just as much as it could be Andreessen Horowitz. We think playing offense in positions like that, building your ownership and making sure that you can control the game, is, a very interesting strategy for us. And then there's others where we need to play defense, and that's making sure that, we are going and getting positioning to make sure that the company is either getting to profitable as fast as possible, or we're protecting ourselves with certain rights to make sure that we can't kind of get bullied around by the big VCs. That we think that being aggressive on the positions that we think are going to scale, and being defensive to make sure that we aren't relying on, hey, if we can't get Lightspeed to come in or Andreessen to come in this round, then the company's dead. It shouldn't take $150 million for every single vertical SaaS company to get to profitability, and a bunch of ours don't.
So how do you think we've kind of gotten into this state of being when you say you need $150 million to like get a company profitable? Kind of sounds insane, but it's kind of the standard, I guess.
I mean, show me the incentives and I'll show you the outcome.
Okay, so what are the incentives? Someone who's listening to us and they're like, I don't get the incentives. I don't understand why this would be a problem.
So when you look at venture capital as a game, it is a way better business to be in the fee stream game than it is to be in the carry business. I got into venture to be in the carry business, not into the fee business.
What does this mean for someone who doesn't
know? So when
you
think of the 2 and 20 model, 2%, management fee and 20% of profits.
So you raise money, you charge 2% of the money you raise every year in fees.
Yeah.
That just like, it's like revenue, quote unquote, that comes into your business as an asset management
firm. And 20% of the profits that you generate on a net basis. So if I turn $100 million into $300 million, after fees and everything else like that, I'm collecting $40 million, i.e. 20% of those profits.
Because you profited $200 million and you get 20%, so $40 million.
So the reality is the number of funds that have had more than 3x funds more than 3 times is extremely, extremely small. It's actually just a handful of funds.
I'm sure we could come up with it on just 2 hands. We could probably close.
I've gone through the list with one of our LPs, and they're like, if you can 3x 3 funds in a row, you are literally in legendary territory, because out of the history of venture capital, especially over the last couple of decades, there have been thousands of firms And there's less than 10 that have actually done that, which is insane.
Yeah, that's super surprising. I would assume it's
turns
way
out
higher.
median venture returns are actually pretty bad. And, so when you think about that, it's a lot easier to be in the fee game. We're going to go raise a ton of money because LPs are going to get, and that $100 million fund, I'm actually going to clip down $20 million in fees. And, it turns out that if I can 2x a $200 million fund, I make way more money than actually 3xing or 4xing, i.e. generating a way better return for my LPs, a subsequently smaller fund.
Plus, if you raise the fund, you guarantee, quote unquote, like you're pretty much going to get that money.
Well, you're also getting a time value of money. You're getting that money today, whereas like right now, like I know the numbers of our fund, but none of them, it's not like I can click a button and access that. I'm going to wait 7 to 10 years to get that. And all along the way, I'm putting GP commitments in and so forth. So the reality is, it's a better business to be in the fee business. And actually, the public markets treat it as such. If you are an asset manager, the value that you get from public market investors is based on your fee stream, not your carrier performance. And I think it's like something like, 15 times fee stream is what most of these asset managers trade for. That the terminal value, i.e. like the worth that they give to your business for your carry is next to nil, which is crazy because at the end of the day, that's what matters. Are you beating public market equivalents? But because public markets and fee streams and the way that this 2 and 20 model has evolved, has anchored the incentives around management. Every venture firm wants to scale. Just the way that in private equity folks scaled, and that's the reason why we have Blackstone and Apollo and Carlyle, $100 billion entities. Venture is heading in that way. Along the way, we kind of missed what made venture special, and that's that this is the only asset class that was about the carry, that you can actually get more than 2-3 bagger fund, and that there are cases where you can get 10-20 bagger funds. And, I think that's the special side of this business, but as the incentives change, the behavior changes. So.
Yeah. And so if I'm a founder and I'm just thinking about, I'm learning more about this and I'm thinking, I might want to raise a little bit of money for my first round, like $1 million, $2 million, $3 million, 10 million, 20 million. There's a pretty broad range. Like, what do you think I should think about? Like if I'm approaching an equal, like you guys, or if I'm approaching someone else, what should be my thought process generally of like thinking about how much money I should raise?
I think it really depends on like the partner that you're working with and making sure that there's alignment there. There are many ways to win in this game. The reality is if you have misalignment with someone who's on your board, especially as that board gets control of your company, which ultimately is going to happen at some point.
You feel like?
Yeah. I think most companies give up board control in some capacity by the Series B or Series C.
Okay.
There's some cases where that's different. I've seen companies give away board control at Series A. Now, like I would not recommend that. You as a founder, it makes sense for you to hold on, to control of your company for as long as you can. But if you're going to continuously raise capital, there are tons of horror stories of people who have raised too much money, given away control of their company. Late stage investors ultimately, have different incentives. At the end of the day, all they want to do is get their preference structure back. And that means that a company that was once valued at $1 billion sells for $250 million. Late stage investors get their money back. Founders and early stage investors get washed out because different incentives are put in place. So I think making sure that you share incentive alignment with your investors is extremely, extremely important. That's one of the reasons why like we've decided to keep our funds smaller so that we can maintain alignment with founders rather than getting too big to the point that the seed stage check doesn't really matter.
But it sounds awesome. Like if I raise $1 million, I can raise 10 million. Like raising more money just sounds great, right? Because it'll solve your problems.
So why do you think it solves your problems?
You get more money in your bank account. I mean, in theory, that's the pushback, right? It's like you want more money to work with, right?
See, like a company like Viva likely could not, Viva raised a combined $9 million before going public. It's a $30 billion, $40 billion company right now.
And it's like a CRM verticalized for health.
It's a verticalized CRM for life sciences. Right. So Emergence Capital is the only investor in the company. The CEO was the CTO of Salesforce, Gordon Ritter, who led the investment at Emergence. He had worked with Mark Benioff to start a company before that. Emergence was an investor in Salesforce as well. And you look at the capital efficiency of a company like that, or Google, which I think had raised $30 million before going public. Yeah. It shouldn't take that much money to get a lot of these companies profitable if things are really, really working. The amount of downside scenarios that can happen when you raise too much money are really perilous. And that's...
Can you just explain like a bad case scenario to me?
Look, if you take a down round, it's most investors will not do the work of doing a down round. Like
They'd rather just let you die.
Yeah, they'd rather let you die. Who wants to, if you believe venture is a momentum game, then you need $10 billion outcomes. What real incentive is there to go and save 50 cents on the dollar, 70 cents on the dollar of what you have? And there really isn't a private equity landscape for companies that aren't profitable. So, the reality is like down rounds usually don't happen. Those companies just die. And I think sadly, we've seen a lot of that over the course of the last year of companies that raised a lot of money, maybe raised at $1 billion valuation. Founders got excited that they had a unicorn status, decided not to click the secondary sale button. And all of a sudden they're looking 12 months later, hey, I'm doing okay. I'm 15 to 20 million in revenue, but there's no chance I'm going to be able to raise on 60, 70 times, my revenue again. And it turns out my investors don't want to put in more money. Turns out actually the person who led my round is now at a different firm. They're incentivized to do different things. I'm left here by myself and I can't get to profitability. So now my company is actually not worth $1 billion. It's not worth 100 million. It's worth 0. And that's a really, really tough situation to be in. That I know founders who have been at it for 10, 11, 12 years, built companies 50, 60, 70 million in revenue that are walking away with nothing. Mm-hmm. And that's actually really sad when you think about it. All the hard work that goes into that to be in a position where like you once thought you were walking away with $100 million. Yeah. And instead something else happens, which, the first 2 companies I exited at my prior firm, one was a company named Vettery, and I think they raised about $8 or $9 million total. It was like us and Graycroft were the primary investors in the business. They sold it for a little over 9 figures. Each of the founders made good money on it, and enough that they would never have to work again in their life. But they raised $8-9 million and sold, had a great outcome. Not something that any venture investor, especially like one of these, gigantic firms, would ever talk about.
I've never heard anyone mention this company before. Yeah.
So do you know who the founders are?
No, I've never heard of this company before.
So it was a talent marketplace based here in New York. I think it was the second investment I ever made. So the founders went on to start 2 other companies. One was Archer Aviation, which they started in my office when we were starting Equal. Archer Aviation is an electric vertical takeoff landing company that's now a public company, probably the leader in the space, multi-billion-dollar valuation. Brett has subsequently gone on to found Figure, which you just made an announcement about breaking up the partnership with OpenAI. They are I think latest valuation on that was $2.6 billion.
Are you an investor in that one?
I'm not. That's not what we do. The reality is like Brett and Adam have been, great friends to us and, seeing that company go. But going through that first doorway of having a really great exit, making life-changing money for each of them, it opened a door to something that was very different. And I still look back at, I had this VC mentor in New York at the time. When I told him I was going to do the Vettery deal, he was like, these guys aren't real founders. Like, they're finance guys. They went to University of Florida. Like, these guys will never make it. He literally had the audacity to tell me, he was like, Rick, if these are the types of deals that you're going to do and the type of founders that you back, you're never going to make an adventure. And I find that so hilarious that I'm like, okay, like, now these guys have built like 2 multi-billion-dollar companies, and a lot of people think very highly of Brett and Adam, and
it's funny that you then didn't invest in the other 2. That sounds like bigger numbers.
No, you got to have discipline in what you do. Like I don't regret like either of those. Like it shows you the importance of founders. Like if you believe in people, they're going to find their way to great things. Yeah. I couldn't be happier for either of them. But the reality is like, you can see that what a great founder is definitely changing, but it's also a completely subjective bullshit thing. But the reality is like in today's venture ecosystem, I'm not sure Vettery would have ever been funded. And that could have actually completely changed the dynamics for that, the trajectory of those guys' career and, the humanoid space,
Yeah, that's true. We wouldn't get the Figure robot taking over the factor.
I'm sure you're going to buy one. They
seem cool.
I'm hoping to have one in my home soon. The videos are pretty awesome.
So you kind of brought this interesting point where a lot of the funds have gotten bigger. You may or may not want to take some of these bigger rounds. Like, why is it happening? You just talked through this. It's like, okay, if I'm a founder, I can raise $5 million, get to profitability, sell my company for $100 million, life-changing amount of money. Why would I then raise 20, 40, 50 million? Like, is it something with like fund size dynamics?
Like that's it. I would say this is the biggest mistake that I see first-time founders make is that the allure of the valuation of the venture firm's brand and everything else is what pulls them in. And look, the sales process that those firms throw at you it's strong.
Okay, so can you describe the process to me?
Oh, I mean, you're getting phone calls from like the CEOs of the firm, and they're having LPs call you. They're throwing out all the stops, maybe taking you on our private jet. Like there are a lot of things that they throw at you to kind of make it look like that you've made it. Like, and the reality is you haven't made it until the company sold or you've taken it public. Yep. But I think that there's a lot of allure in that process. I think one thing that I grew up like in this industry, backing first-time founders that, largely finding needles in a haystack. 5 of our last 6 founding teams have been led by people who built billion-dollar companies before. And I think
is it equal?
Yeah, at equal now. And the reality is I think a lot of that has to do with a lot of these repeat founders saying like, I've seen that product before. And I know what it is and I know what it isn't. I want to bring in somebody who will be a true partner to us and help me navigate the stage and be the bulldog in the boardroom to help me navigate those type of situations. And we've really aligned with a lot of founders on that. And, I think that's a nice spot to be in. I'm certainly not taking any founders on private jets like anytime soon.
You don't have a private jet?
I do not.
No.
Contrary to popular belief, our $100 million core fund does not quite have the fees to pick up the NetJets membership. But, once you get in the carry game 10 years from now, hopefully we'll see it, maybe.
Yeah. Then you'll get the private jet. You can compete with the big funds. Like, hey,
when that happens, I'll probably be like a hermit living in the woods. Like, that's probably a little bit more my style. So, yeah.
Yeah. So it kind of brings up an interesting point where like today, a lot of companies that seem to be getting funded, a lot of AI stuff. I think I saw a stat. I forget the number. I'm going to forget the number, but it was like 40 or 60% of all venture dollars and like specifically early stage was going to AI companies. How do you feel about that? So
I think AI is like every single hot buzzy thing that's happened over the course of the last 6 years. Shai Goodman, formerly from SVB, then Brex, had like a really funny tweet maybe like 2 years ago about like, here's the hot thing that happened every single year. And actually, if you looked at it, whether it was like VR or like gaming or like mobile or scooters,
is my favorite one.
Yeah, like actually, if you invested in that year in that asset, you perform terribly. And
like a 0.0x.
Yeah. The reality is like investing is a buy low, sell high game, not a, buy high and hope things keep on going higher. And perhaps there are some folks who have made money in that game, but largely the basket of those years has underperformed. So my belief is AI is going to change a lot of things, but it doesn't actually just create a new category. It just accelerates what are already good businesses, or it accelerates the demise of what are bad businesses. So, what we've seen is that our companies that have really strong network effects, really strong flywheels in their business, when they go and, start implementing components of AI, they're accelerating very, very quickly because they're great core businesses. If you are an AI agent or bot or some type of application that's out there with a couple $100,000 of AR, that means absolutely nothing in today's game. That I was speaking to another investor and they were talking about what's everything around legal AI and legal contracting, and they said, Rick, every single one of these companies is working. If every single company in a category is working, that's probably the scariest thing that could happen, because that just means that, there's no alpha in the company that you're generating. It's just the entire beta of the category. And we saw that happen in mobile. We saw that happen in internet. You saw all these companies rising at the same time. But what you really want to determine is which one is Amazon and which one is pets.com. And I think that's where actually like the true, investing and true work that needs to go in is how do you determine company quality amidst this, which there's a bunch of great companies getting created, but everyone's just throwing money at this category with a non-discerning lens. And sorry, but like, I don't believe that investing at a $500,000 of revenue, like a $500 million valuation, and something that doesn't have moats, doesn't have durability, I personally don't think that's going to work out in a long span, but there's certainly a lot of people who are just shooting the cannon and saying like, you know what? It's a lottery ticket. We'll see what happens. Like, I need to be in this space because of FOMO. That's just not the way that we're going to play things.
Yeah, because I think people, you see the data and like the pace that some of these companies are accelerating is like the fastest ever, right? Like I think we were just talking before we started recording, we were like, this company went from 0 to 20 million ARR in a month or two, right? And that used to be like a 10-year process, or a couple of years before. But it's kind of interesting. Like I think with crypto is another one of these phases where the company saw really rapid adoption. If you're looking at a spreadsheet, you're just looking, even if you're looking at revenue and EBITDA numbers, they looked pretty good. And I think it's kind of interesting when you frame it next to AI. Like you take these two new technologies, right? Blockchain, crypto, NFTs, and everything we're doing right now with LLMs. If you're a board and you're talking to the founder, you're a management team, and you're like, you know what? This crypto thing, we probably don't need an NFT strategy. You're an airline, you're like, we don't need to launch an NFT. It's pretty easy to just kind of dismiss that and be like, we don't need to do that. But with AI, it's like, we actually could probably incorporate this in some way. So
but think about mobile. Like mobile, we all have some form of how we've incorporated mobile into almost every single technology platform. But there was companies like Uber that had amazing network effects associated with what they were doing. How many mobile CRM companies did we see? Like I probably personally saw like 20 like that I was looking at the time, because
so it was like an app that was a CRM.
It was a mobile first application, for SaaS. How many of those are still around? Like virtually zero.
Yeah, it was just Salesforce made an app.
Like
it sucked.
The companies that actually had the inherent platform advantages were the ones that ended up taking advantage of that. And I do think like that's what we're going to see. There's a bunch of incumbents that have the capability and the capital to make sure that AI can work for them the same way that mobile did. Yes, there will be some AI native companies that emerge from that. But I think the same impacts that we saw from mobile, or every single technology intervention that demonstrated that leap, is different than, saying, okay, this broad basket of like, if you're an AI native company, then you're going to kill it. And I think the crypto thing is, that's a whole different universe. Like I'm an LP in some crypto funds. We don't do any crypto investing. I refuse to make that part of my universe. It's just very different. Like thinking about, we're neoclassical value investors. We think of how is this company going to generate a ton of cash flow in the future? If you're a crypto investor, you need to be thinking about liquidity, capital markets. It's almost like you're a commodities trader.
You're day trading.
That's not what I do. Like I want to be in something, watch it run for 10 years and hope at the end it's doing $1 billion of cash flow.
Like you're solving a problem and you're generating revenue and profit because you're solving problems for customers and making their life better.
I mean, look, there's a lot of different ways that you can win. And I think plenty of people have won a lot in crypto, but the people who lost were the ones who entered late, didn't know what they were doing, didn't see ahead of the curve, jumped in 2021 and 2022, did companies at $10 billion valuations, then watched them go all the way down. The folks who were the big winners, are the folks who saw ahead of the curve, said, hey, I believe there's an opportunity here, and then click the sell button in 2021 or 2022, or when those companies went public, perhaps held on some of those stakes. So I do think, for better or worse, you need to be thesis driven around where the market's heading. And, with that, regardless whether it's AI, crypto, mobile, being ahead of those trends is really, really important, which if you look at the companies that have been the most valuable emerging from this, OpenAI, when was its seed round done? When was the Series A done? It wasn't done
in 2023.
Yeah, it wasn't done amidst all this hype. It was done before it. And now people are investing at these valuations that, look, you can get serious money to work. And if Moss is going to mark you up, that's a pretty good situation to be into. But
maybe,
there's
maybe not.
Especially if you can get liquidity. But reality is it's a really expensive game to play, and I don't think that's venture investing.
And I think it's kind of interesting. I think you brought up this point earlier where a lot of the benefits of AI have just been Facebook just runs better ads, or Accenture, I think. I forget the number, but they're doing
I think it's $8 billion
of just implementing AI products for their clients, their consulting clients.
Yeah.
It's more than every startup probably, other than OpenAI and Anthropic maybe, or maybe it is the same as them.
If you look at most services companies, or the revenue that Deloitte, Accenture, McKinsey, Bain, BCG, gets, these numbers are gigantic. And if you look at what AI does really well, it's doing a lot of knowledge work, services.
It's basically their business.
It's we do a lot in insurance. And all I'll say is that there are a lot of bodies in insurance that are doing redundant tasks that don't require, much creative thinking, but require document extraction, document generation, some form of business logic that's formed in that. Insurance is an area that's very ripe for AI. That as I look at this landscape, and I think about how are you going to create production value, i.e. like how are dollars that we invest in technology going to lead to economic value? I actually think in private equity and in service businesses, they will make way more money in production value than venture capitalists make in total revenue from those companies. And I think that's intuitive. When you think about it, like, hey, the 10x principle of, hey, a customer needs to reap 10 times the benefit that they're willing to pay for something. And I think that's not exactly the case in today's day and age. But the reality is, if you believe that to be the case, that customers are going to get 10x the benefit, it is a really, really great time to be in the private equity business right now. That you can go, and look at a portfolio and say, man, I could probably eliminate 10 to 15 percentage points of EBITDA. And if you look at your existing basket of companies, especially those who have distribution networks in place, maybe have some like real IP around their core business or core data sets, like you're going to see a bunch of those legacy companies starting to look massively, massively profitable, which, I talked to our LPs and said, like, hey, this is not what we're going to do, but like, I bet you a private equity fund would make more money than a venture fund right now, especially with the way that venture assets are being priced.
If you just think about the PE playbook, it's like slash costs and flip it. It's perfect for them.
For all our companies, like I think a lot about market share being the best leading indicator of margin, margin being the best leading indicator of cash flow. So the reality is, if you think of the ability to invest in AI to accelerate your domination of a market, competition is just bad for business. So if you think of, we spent some time looking at the claims automation space, and there are a couple players who own, the majority of data or maybe a third of the data in the space, low margin businesses. They've been around for forever, but, existing data sets that are truly proprietary to them because there's an input and output on both sides. You're like, yeah, right now, the reason why those are low margin businesses is because it's someone manually tagging photos all day. You're like, man, what would scale AI do to this business right now? Like, what would implementing AI do into some of those? And I truly do believe that you could actually fundamentally, reinvent the margin structure of those. Think about collapsing the pricing structure, pushing the others out of the market who are late to the game. And then all of a sudden, you're sitting on top and owning $1 billion revenue business with 30 to 40% EBITDA margins. Like, that sounds pretty exciting to me. The reality is this is where the nexus of private equity and venture start coming together, which I think we spend a lot of time with private equity investors. I think that's one of the benefits of being here in New York is that, when I went to business school, like venture was kind of considered the pat on head venture, like asset class. It's like, oh, that's cute. Like you're managing like, I went to business school reunion. Everyone's like, oh, like, Rick, you're managing like a couple $100 million. Like, that's cute. Like we got a couple billion. Like, and I was like, oh, okay, guys, but the reality is, those folks working in venture and technology, they're starting to actually be more interested than they've ever seen them before because they realize, hey, this isn't like innovation theater. We can actually make some real money off this type of stuff. Yeah. And the reality is most AI-driven products are so underpriced right now, that, it's a pretty easy trade for both sides, to make sure that there's value being created. So I think private equity is going to make a lot of money off AI.
And you think, so Johnny, the playbook is low margin business. So they have an existing kind of just like cost structure that's there. They have 5% margins. You can actually lower their pricing. You reduce the labor overhead that goes in. You can maybe speed up using a lot of the AI tools. They're probably going to get better in the future. The cost of those is going to come down. And then you boost your margin on some, insurance manual business from 5% to
I don't think it has to be like insurance. I think I think there's good, better, best here. And I think good is, hey, you found something that is a high services business that has a lot of low logic tasks that AI is really, really good at attacking. That's good. But I actually think that those businesses will largely have linear growth. Then you'll see a bunch of different players go into them. And I actually think that's how I'm seeing the claims space evolve right now. I've probably seen 15 different claims automation companies. They're all competing for the same customers. I'm starting to see pricing curves come down a little bit on that unless you lock up like a really interesting asset, I think that's going to be like, it's disruption at its core. All the legacy players are going to die. New players are going to emerge, but then margin structure for those are going to compress over time. I think there's good opportunity to make money in the short term, but companies are ultimately valued on their long term. I think the better is, hey, we actually have some really unique data set that we have here that because that we can get, a true advantage over, other folks in the industry. So if you look at some of the players in the auto claims market, for example, there are players that have data on what an accident is, what body shops will charge for every single car. They have, endless amounts of pictures of what's happened, and that there's a lot of opportunity not for, just cutting the fat, but actually having a beyond incrementally better service than everyone. Then you can actually see that there's a little bit of a moat that they're establishing against the competition because theoretically, the better the data that they have, and if they can keep on subsidizing that, they should be able to deliver a better quality service than those who don't have the advantage of that existing data set. I think really the best is you become a monopoly. And I think that requires like a very patient path to, all right, undercut the competition because you found a way to reduce your services. You've locked up a monopolistic data set that maybe you have a third of a market or something like that. Go and buy up the rest of it so you can own it and have 60, 70% market share, start pricing everyone else out, that you can own 90 to 100% of market. And I think the reality is like, those are the businesses that when you can own 80, 90% of a market that are just going to have absolutely massive amounts of cash flow. You don't have to spend anything on sales and marketing. You can charge whatever you want because you have pricing power over the customer. Those are the best businesses. So what we really would love with AI businesses is cases where we have found a monopolistic data asset or a monopolistic network effect. We think we have a couple in our portfolio. And then how can we supercharge that and make sure that we accelerate owning 70, 80, 90% of the market? And I think this actually pairs very well with marketplaces as well as platform companies that are connecting people on both sides. That if you can do that, then that's actually like just a cash flow monster.
So you have this concept of captivity being super important. Is this kind of what you're getting at? Is like capturing sort of proprietary data of some kind or workflow of some kind?
I think it doesn't have to just be data. I think, so Bruce Greenwald, he was a professor at CBS. He was like kind of this age to like Warren Buffett, like big influence, on him as well as a bunch of other investors that we respect. He really embraced and kind of thought about this concept of captivity, and captivity can be on the supply side or demand side. I think he called it resource or customer, but the reality, it's how can you have power over that side of the market? How can you have power over, customers or your suppliers or vendors? Very Michael Porter based.
So it's kind of this concept of like, they must use you.
Yeah.
Okay.
So like if you're in a complete commodity market with perfect competition, the reality is you have no power. Like if I'm selling apples at the farmer's market, it's a pretty competitive market. You can look at Turner's apples versus Rick's apples. His are 99 cents. I'm trying to charge $1.49 for mine. And like the reality is like most people are going to choose the ones that are 99 cents unless my apples are, look shinier and, whatever it is, yours
next to the cookies or like some fancy, like high traffic area. Nobody wants to come to mine.
Well, the reality is you're going through a slog to trying to convince customers to buy you. Whereas like if you're the only person selling apples there, you can charge $5 and there's going to be people who buy them. So, you want to find markets that are structurally enable, captivity to happen over customers, and then find ways to actually lean in on the core competencies of the business to reinforce that and make sure that you have some compounding advantages. So you can think of this as everything from having a furniture store in the middle of nowhere. Like if you are the only furniture store within 200 miles, you want a couch? You're going to buy it from them.
You got to pay $500.
Yeah, you got to do that. Versus, hey, you want a cup of coffee in New York City? There's pretty high, perfect level of competition on that. So, we look for businesses that either have, the potential. Most of the businesses we do are,
because you're starting the company, right? Like you don't
not
know.
Always, but a lot of the companies we do, like we are funding shortly after incorporation. Sometimes starting the company with the founder. Sometimes they've been around for a little bit, but like we never look at traction as like a core deciding factor for whether we're investing in the business. Oh, really? It's really about I actually think like traction is extremely overrated.
That's like the number one qualifier for most people, isn't it? Most investors.
I think here's the reason why. If you are a strong founder, you can actually fake product market fit.
You can fake traction going up.
Yeah. Like, look, if I were starting a company tomorrow, like, could I call up a bunch of insurance customers that have worked and be like, hey, give me a 6-figure contract. I'll do some of this stuff. And I'm like, I kind of did that during business school. Like, I had a startup that I was able to go and get enough traction for that, like, we could, had actually, like, some serious ARR. Now, was that company actually a good company? No, it was terrible. Like, it was awful. Like, I don't even put it on my LinkedIn because I'm so embarrassed by it. That, like, the reality was, it was like, we were basically like a software dev shop, and, it wasn't real. Did we have product market fit? No. Like, it was a, side project that I did, like, for business school credits that, like, somehow magically stumbled into some revenue. Like, and, so as I think about that, like, if you're a good salesperson, you can fake product market fit. You can at least achieve, some level of what investors would consider from a metric basis. Yeah. I think the more important thing is finding your path to moat. And that's actually the thing that we focus on. Like, when we're working with a company, like, it's not how do we get you to $1 million of ARR? It's how can we get you to that first demonstration of that you have a moat over the competition. And that's, hey, how are we starting to demonstrate that you have, like, a real network effect with the business? Or if it's a tech-enabled service, that you have actually the potential, like, on one of the 4 kind of core unit economic metrics, COGS, CAC, OPEX, or willingness to pay, that you've been able to outpace everybody, in the competitive landscape on that. That path to moat is ultimately the thing that gives us conviction that you're going to be the winner take all of the market, the category, leader. And that's what we focus on, which is generally not going to be determined by whether you have $500,000 of revenue. Yep. If you've been around for 6 years, do I want to see that you have customers, that some level of capital efficiency? That's actually more like a function of us determining whether you're a good operator or not. But, like, some of the best businesses that we've been in, not only were, ones that either didn't exist, like, i.e., like, we funded them at formation. I think of 2 of the best businesses that we're in today were basically flat for multiple years when we invested. But we developed conviction in the founder. We actually convinced them to pivot their model a little bit. And with that, they've exploded since. And, I think that's the reason why, like, we're not in the finance game being seed stage investors. Like, if I'm looking at your CAC LTV ratios as a seed stage investor, I'm doing it wrong.
I think I've heard you describe before this, like, compounding returns on equity. How maybe it kind of plays in this, like, compounding returns on invested capital. How should I suss that out? Like, if I'm an investor thinking about this, or maybe if I'm a founder, just I've never even heard this concept before. Or, like, how do I implement it in my own business? You kind of hit on it a little bit, but
yeah, I think, look, flywheels happen all around us. Like, the reality is, like, are you getting better every single day that you're doing this? What are the things that you do that develop value, increasing value every single time? This podcast is one of them. Well, when you think of, like, when we met years ago, like, that was a big investment that you made into, your brand and the media platforms and now that they kind of just work for you. Like, I think about how much work you probably had to put in back then versus, like, the unit of effort that you had to get a unit of value is so much worse back then than what it is today. Well, and that's demonstration of compounding value.
Yeah. Like, so I guess, to explain to people, like, I think the first time we met, I was working in an LP and I DM'd you. Yeah. And there was probably no reason for you to talk to me other than I was, like, pretty strategic of, like, I work in an LP and you're like, yeah, I'll talk to this guy, like, whatever. Like, that's probably why.
I talk to everyone, man,
and then if I would have been like, hey, at the time, like, hey, Rick, do you want to sit down for 2 hours and, like, we'll talk about all this stuff? Who knows? Maybe you would have said yes. But if it would have been like it was truly a last minute, like a day ago, I was like, hey, do you want to do this tomorrow? And you're like, yeah, let's do it.
Well, think about it from the reward side. Like, now it's like, if you had done that back then, maybe you'd have like 100 people listen to.
Fewer.
Like, probably
it would have been like 10 people.
Yeah. Like, and now, like, you put something on TikTok and, like, what's the, biggest thing, that you've had on TikTok in terms of total number of views?
TikTok only like 122,000, but on Twitter, like, I've had stuff get, I think my biggest tweet was like 43 million views or something like that. Like, something a little bit ridiculous.
So you had to invest a lot into that compounding asset of, like, your Twitter following. And now, like, when you do something, you could tweet out something that is probably not particularly novel and it's still going to hit, hundreds of thousands, if not millions of views because, like, it's just you have this compounding asset. Meanwhile, like, I tweet out something and no one cares. They're like, oh, like, grumpy Rick, like, talking about value investing and venture, like, on Twitter,
like, what is this?
Let me fall asleep. But reality is, I think that's how businesses need to think. It's not about product pull or like the customer today. Businesses are not about your revenue multiple today. It's about ultimately the value that you can generate in the long term. And that's like how a discounted cash flow model works. And that's how all of investing is centered around, ultimately how much cash flow can you produce as an organization? So, and you can see this with the best businesses, like they go through these J curves and then all of a sudden, I have mixed feelings on businesses like Tesla, but it's like, oh, you were unprofitable for like 13 years and now you're starting to have some cash flow. That's what investors were doing.
Every other automaker, and like some of them are probably going to go bankrupt now.
Yeah. So I do think like all that is because, Tesla has its series of like moats and compounding advantages, whether it was their, EV charging network, their IP, a bunch of other things that you can, throw in there. I think there's better demonstrations of this like Google and Amazon and so forth that have become absolute cash flow cows. And, I think that's what you need to do as a founder is find not the way that you can go and incrementally get that next customer. Mm-hmm. That's one thing. How do you create a machine that starts working for you when you're not working?
So like, how do you get that next customer easier or faster than before?
So we think a lot about incremental ROE or like what's your moat, return on equity. So, how can you as a customer or as a company outcompete everyone? And if you're getting 20% return on your equity, which is great, and everyone else is getting 8%, you're going to win. Like you will ultimately win that market provided that you have enough time and capital. So like the company that has the strongest flywheel, that demonstrates the biggest moat will always win the market provided they have enough time and enough capital. Now, there's plenty of capital in this game. And if the market opportunity is big enough, VCs will give you the capital and give you the time to go get there. And certainly there's plenty of patience in this game for like companies that aren't profitable, provided that the size of the prize is big enough.
So how do you think I should think of that? Like if I'm a founder, I'm starting a company, I really resonate with and I think in the same way, how should I show that when I'm talking to investors or like building my company in the early days? Like what things should I approach, or maybe how you guys will do diligence on me? Like how do you tell that I have compounding advantages like as I get more customers or build my business up?
Well, you got to separate the business from the founder. Like, I think like for us, there's really like 3 principal things that like we look at. And like one, we're developing conviction behind a market opportunity. And generally, like we only meet with companies if it's in something that's on like what we refer to as our hunting range, which is our like big board of like what are our biggest ideas.
What are those so people know?
It changes actually pretty frequently. So we only invest in 4 categories: energy, insurance, retail, supply chain.
You said energy, insurance, retail, supply chain.
Yeah. Okay. So we have 3 product owners, which are industry segment leaders that are responsible for driving our research, building our network of bridgers, which are kind of our industry experts and like private equity folks that we work with, customer networks that we have in those, and sourcing, within those channels. But in each one of those categories, energy, insurance, and we bundle retail and supply chain together. At any given time, we have between 3 and 5 of like, these are big ideas that we're doing a lot of outbound sourcing. We may be speaking to folks about like forming a company there. Occasionally something walks in our door that's in one of our 4 sectors that we're like, this is really interesting. We hadn't thought about that idea, but I'd say about 85 to 90% of the deals that we've done as a firm over the course of the last 6 years were eventually at some point on our hunting range. Okay. So we develop conviction around a market opportunity, and then we try to develop conviction around who's the best founder in that space. And then we want to make sure third step is how can we get alignment on kind of the strategy that we have with that founder for how you're thinking about business value creation. And that's generally the approach that we've leveraged across, and we like to think of ourselves as not the operators of business, but like consultative to the founders, is this concept of like wedge, flywheel, moat, expand. So what is your wedge to subsidize getting critical mass for the company, i.e. like that initial product market fit, you're starting to get some product pull. We generally, like mechanisms like counter positioning or how can we incentivize people to get on our platform. Sometimes that wedge is just like, hey, we have a pre-baked network of 25 customers. Like we just did a company in the insurance space, 2 weeks in, 8 design partners. And it's because like we've been, explaining the concept to customers for, 6 months in, but this company literally did not exist 3 weeks ago. We funded it 2 weeks ago, and now it has 8 design partners, and that's a good wedge, but we think a lot about what's the flywheel behind the business. What is the thing that we are anchoring on that will provide perpetuating increasing returns to scale. Is it a data network effect that we have? If it's a marketplace, we're thinking about customer network effects. If it's a platform business, we're thinking about how many developers can come on that bit. If it's tech-enabled service, are we seeing something that's going to, demonstrate the potential that maybe it's economies of scale, that enables us to have an edge over the competition the bigger and bigger and bigger we get? What is the thing that incentivizes us to be big? If that, does it generate a moat from the competition? And, is that us having a better economic profile than the competition? Is it us being the only player in the market because we have a network effect and there's only going to be, it's a winner take all market composition? And if you have a monopoly, if you have a moat in a market with a flywheel, there's plenty of additional opportunities adjacent to any single business that you can imagine that you can expand into. So that wedge flywheel moat expand, we generally we'll spend a lot of time looking at a market, figuring out the customers, diligencing the opportunity before we even meet a company, but then figuring out who's the best founder, and then really trying to say, all right, how do you want to go attack this market? What's our path to moat? And really getting conviction behind that story and whether we align with them and whether we think that they have the mindset of not just being a great operator, but knowing how to win a market rather than just be one of the best players in it.
It sounds like you have quite of a public market or a Charlie Munger more type approach, value, like you said before, value investor type approach versus more of the, venture technology investor approach.
Yeah, I know very little about actual technology. I think one of the investors that joined our team last year was does Rick ever use his computer? 2 to 3 days
does
in.
Does he know about ChatGPT?
What's that? The reality is I'm much better off on the phone and whiteboard than I am on a computer. And that just is the nature of how I've always invested. I came up in consulting and private equity, landed in venture, not because I was deeply technical, but because I thought this was where you had the best alignment with founders for building businesses, and that ultimately, where I could help bring something new to the table that others hadn't. And, so we do bring a tremendous amount of what we believe is the best way in creating business value is not just in building products. One of our founders asked me for help on, some, algorithm, pricing algorithm thing earlier this morning. I was unfortunately, I'm not the best investor to help you on that, but we do think that the way that we've positioned ourselves is, and how do we think about monopolizing market opportunities? How can we, go and actually build a moat around this business? How can we leverage the customer networks that we have with people who we have a kind of shared belief around value creation with? So we spend a lot of time with private equity folks.
That's just kind of weird for a VC to tell me that.
So I'll say private equity folks are the most rational buyers of IT that you will ever find. When you think about it, they're not making political decisions. All they're thinking about is, how can you make me more money?
Yeah.
And
solve this problem. I want to
you
generate
solve
more
this
cash.
problem, I will give you business.
Yep.
So and if you show up and you do that over and over and over and over and over again with folks, they develop a lot of trust with you. And I think one thing that we've been fortunate is that through this process of me doing this before and me doing this now, in our firm continuing to build upon this, is helping will businesses into formation, because we're saying, hey, AI services for insurance, for example. We've spent a lot of time with private equity firms, big corporate buyers who are we need to figure this out. We went and met a ton of companies in the space. We developed our point of view. We found a pretty exceptional founder that I've worked with in the past who's built $1 billion company before. And we spent 6 months working on that together, and now he's at the point that okay, can he solve that problem for you? He's built $1 billion company before, deeply technical. He's sold to a bunch of these folks before, but we can get in earlier to those opportunities because the private equity firms are hey, we need to go and find a way to shave 10 points of EBITDA off every, or 10 points of cost off every single one of our companies. Hey, Rick, we have all these services companies. Instead of, us going and building our own AI team, which we have no clue about how that works. Can you go and help bring in somebody who can help us do this? And we're just going to run through a bunch of these private equity portfolios, which are all multi-billion-dollar companies, and pick up a lot of revenue from that, which, I find that exciting. And I find the alignment of interest, the private equity folks make money, the founder's going to make a lot of money. We own, a decent chunk of the company, so hopefully we all make money on it, but like everyone brings something different to the table.
Yeah, it's kind of an interesting go-to-market almost for portfolio companies, where instead of like you go to one customer, that you go to this customer, quote unquote, that has a portfolio of a lot of different things that they can buy from different companies. So
well, it's also like when you've sold one, then it spreads very rapidly across the rest of the portfolio.
That's like the classic PE playbook too, is like we apply this thing across the portfolio. It's like you land one, and it's like, oh, we're going to use this at all 15 other companies because we've seen how much it works.
Yeah. And they're all looking to get an edge on the competition as well. I mean, like private equity people, they are abruptly ruthless. Like, so there's no like, hey, we're keeping Karen because like she's been here for 15 years. Like
just
they're like,
nice
sorry, Karen, you're gone. Like we found a way to make some more money. And, for better or worse, that actually really incentivizes technology adoption, that I find them to be great buyers, great partners, especially if they can be forward thinking of saying, hey, like, there's not really a ton of risk in us trying this out. So like, let's give you a shot, especially, if they're folks that you've really developed a good relationship with, which fortunately, like, again, being here in New York, like there's more private equity people than there are venture capital people. When I was in Chicago, definitely the case, like, very much private equity town. And same thing with a lot of these big corporates that like, operate with conglomerate-esque structures. Like a lot of folks want digital innovation. They actually just really get analysis paralysis on figuring out like, what should I buy? I don't want to make a mistake. Like I get vendor fatigue. That this is the reason why we believe, Warren Buffett has this concept called margin of trust, which is like, how much margin of error do you get? Because you're a trustworthy player, because you have integrity, because you do the right thing. And I think it takes a long time to develop that, but like we've developed a good amount of institutional credibility with some of these buyers who are like, hey, if you're telling me that this is going to work, like let's at least give it a shot. Like, they're not going to blindly sign a $10 million contract, but it's going to give those companies a shot. And I think like that's where we think there's a lot of opportunity in this new digital age.
Yeah, and you said something interesting where you said, okay, my logical conclusion is I should invest super early at seed stage. I know you've told me before that like seed stage is actually the worst place to invest.
Seed stage sucks.
So like, why are you like, okay, so explain this and why are you doing it?
I'll go back some data from, I think it was from PitchBook, and we did analysis maybe like 18 months ago at our AGM of the delta between a seed stage round and a late stage round. And historically, I think that was like 20 times. So
what does that mean?
So think of seed stage round getting done at a, for ease, $5 million valuation, and a late stage, let's call it Series C, getting done at $100 million. So you would see like the late stage valuation is 20x. And that makes sense after you're talking about failure rates, dilution that you're going to take, time value of money, all those different considerations that like, that's just like the PPS that you have.
Price per share.
Yeah. In 2021, that number hit 45 times. So like that was actually like the most bonkers time to be a seed stage investor. And when you think about that, like let's just call it 50 for ease, like a $10 million seed valuation, like all of a sudden is $500 million. So like in reality, we were all investing in that $5 million. And in 2021, all our companies were maturing and raising at $500 million. So we were seeing like truly the best time in the market to be a seed investor was 2011 through 2019. Like if you were in the market during that time period and not making money, like it's hard to say that you're going to make money moving forward because that was about as easy as it gets. Subsequently now it's like goes back and forth, but around 6 to 8 times. So it's become literally 80% less attractive to be a seed investor since 2021.
And that's probably because the Series C valuation dropped back down from 500 to 100.
It basically dropped down to 100, and seed valuations have gotten extremely expensive.
And they've gone up, So it's basically
now it's like 15, 16, 17 million dollars to get a seed round done. Like, and the prices come down on what late stage, So there's so much competition at seed, and that's because there's minimal barriers to entry. Like raising a seed fund is way easier to raise than a $500 million fund. $20 million fund, $500 million fund, like it's just easier. It's way easier to get access to these opportunities because they're more heavily syndicated. So there's more demand that you can. There's fundraising platforms like AngelList and so forth that'll do that. The competition at seed, as well as these mega funds coming in and just saying like, hey, the seed check doesn't matter. Like, has driven up the price a lot. So I think like seed prices are absurd right now. And if you look at later stage at some of our companies, we're like, we have a company that'll hit 100 million of CAR this year. Like last year, we were able to do a round in that company at a several $100 million valuation. Like that seems like a very reasonable multiple. Like it was actually below public market valuation multiples. Like when we looked at comps for that business, that's certainly not what's happening in like, hey, here's a seed business that was started 2 weeks ago that's going to raise at a 40 cap. Like, that's like what you're seeing from the big funds. And we're starting to see a lot of seed stage funds follow that behavior because they're like, this is what the market is now because that's what
you have to play the game.
You need to play the game. That's on sale. Yeah. So we don't play that game for what it's worth. Like we've always invested in fund one, it was 1 to 2 million for at least 10% of a company. In fund two, it's been 2 to 3 million for at least 10%. We're averaging like 16%, 17% ownership in companies. So like we are more value disciplined, but the reality is it does change the way that we think about investing. That it used to be, hey, you want to get as much ownership at seed and then like actually the later stage rounds are insanely priced. Then now we actually think of, hey, still get a lot of ownership at seed, but it's actually the biggest investment decisions we make are, hey, are we going to put $7 million in this company at the A or $7 million in the B and really do that double down event? And we've put $20 million to work into some of our companies to the point that like the seed stage check doesn't matter as much. But I do think, for better or worse, seed is always going to be our entry point because, one, we want access to those opportunities. And we do all this research. We might as well get compensated in some way, shape, or form for it. Like if we're going to bring all those customers that I think we're always going to be like a seed-focused firm. But very much over the last couple of years, the dollars that we have put into companies have progressed later to actually more of a focus at Series A and Series B, where we feel like the rounds are much more reasonably priced than what they were in 2019 through 2021.
Fair. So you kind of have the capabilities to tilt where you come in at just from like a weighted dollars invested standpoint based on how the market's moving, but you just really want the capability of like, when you start the company, we want to invest and we also want to invest later on too, if you're doing well. Yeah.
I think I believe getting your ownership early is really important. So the question that we have is like, are we building our position and trying to get to like 20, 25% ownership? Which like, obviously, ownership is a big driver of returns. Like, some of our founders actually like don't want a bunch of other investors. So, the reality is like, if we're not taking another board seat and we can get a round done quickly and build to that 20% level, like I think we have 3 or 4 companies in the portfolio that we own north of 20% of the business. Like we love that. And some of those like will be massive drivers for us because we own so much of them. It also takes a lot of the, it leaves a lot of optionality to the founder. When you're talking about like, hey, I think of, a business that I had at my prior fund that we had an offer on the table for $100 million outcome. Company had only raised, I think, $11 million. The investors around the table did not want $100 million outcome. They wanted them to go for the $1 billion outcome. Founder did not sell, a company did not work out. No one's fault at the end of the day. But like if we're in a company and we own 20% of it on a $100 million fund and the founder wants to sell for 200, guess what? We win. Sell for 500, we win. Sign for $1 billion, we win more. Decacorn, we win more. So at least all options on the table. Whereas like if you take $20, $30 million or like a mega fund owns 20% of your business, like don't think you're selling for 200 million. Like,
yeah. So it's kind of like a way to think about it as a founder is, you sort of want to be a material percentage of your investors' business, right? Like you have a company where, if this company does well, it's not like a small little like French fry for you. It's like the whole plate. You're like, I can return a meaningful amount of the business that I have, like the capital that I have in the game. Like if you do well, I do well versus, it's like,
I would say, especially in some of these big funds, you can certainly see that like if the amount of attention that they give to, and I like your analogy of the French fries, but now I'm thinking of a dinner plate of like that little tiny parsley or garlic that's, garnish that's like sitting on the side of the plate versus the steak. They care about the steak. Like if you are a mega fund, you care about Rippling, you care about Deal, you care about OpenAI, you care about whatever one of these businesses is worth $5-10 billion. The company that is doubling year over year, tripling year over year, but is going to be, sell
10 years to get
there. 10 years to get to a $2 billion outcome, like is often not that loved. And that's actually a really unfortunate thing, you know, and the reason why like you need heavy alignment of interest, you know, in this. And I do think that is often lost on founders who are approaching it the first time, you know, saying like, okay, there's a lot of pushing companies to operate in irrational ways that are actually not to their benefit just for the chance that they could get so big. There's actually someone who tweeted about this the other day. I want to say they were from Khosla, and was saying, hey, like we actually made the decision against our own interest to tell the founder to sell.
Yep, I saw that,
because it's like, it's life-changing money for the founder. And I actually really respect the fact that they did that, because I've definitely seen other firms be like, look, like a $200 million exit doesn't really get us excited when the founder could have walked away with 40, 50, 60 million dollars.
Can you explain that for somebody who it still seems like a big number? Like that seems like they would care. Why would they not care?
I mean, you know, when you're talking about them owning only 10 to 15% of a business that sells for $200 million, like,
so they get $20 million.
They get $20, $30 million out of a multi-billion-dollar fund. Like,
so that's like, you know, they'd have to get 100 of those in order to return all the capital back to their investors.
I mean, even think about this. So when we sold RiskMatch, that was a 9-figure outcome that we achieved in less than 1 year. We led a $3 million seed round into that company. And 7 months later, it received an offer for 9 figures. The founder walked away with more money from that transaction than Aaron Levy did making from Box. Like, have you heard of RiskMatch? Probably not. Like, has anyone heard of Kabir Syed? Like,
you mentioned this company to me at one point.
But it's like, hey, like that was a life-changing outcome for him. And like, you know, Kabir and I are close friends. Like, you know, he is a wild, wild individual. And like, he's been massively helpful in so many aspects of my career. You know,
didn't he try to buy you a car or something? What happened there?
So, you know, as Kabir's, you know, Kabir and I always have a bunch of wild stories. And it's like, we had a thesis on basically a counterposition play, i.e. giving SaaS to brokers for free. And, you know, what RiskMatch was at its core was a software application that sat on top of, you know, agency management systems, which are the core system of record in the broker world, gave that software for free, basically, to brokers as a way to monetize activity on the carrier side. So if you could accumulate all the data, and what we wanted to see was if you could get the biggest pool of broker data out there, more data than any other broker had. So our target was 100 billion. You know, that's bigger than Aon or Marsh. If you get all the broker data into one platform, then carriers would theoretically want to connect with you to get visibility into how that's performing, which AIG, I think, gives Aon like $100 million per year just to get visibility into the opportunities that they have. Just
it's
for
kind
direct
of like CAC for them, like their customer acquisition costs.
So they either put it into their customer acquisition costs or as part of their underwriting expense. Okay. So the reality is, you know, Kabir had been at the company for a couple of years. He bootstrapped it. You know, Kabir is this, you know, older guy, you know, maybe, you know, late 40s or early 50s at the time. He lives up in Greenwich, Connecticut. He wears suits. You know, he's, you know, smoking cigarettes outside of the meeting. Like, you know, he's dropping F-bombs every, you know, like 2 seconds. Like, you know, he actually like, the reason, you know, when we got to conviction on him in the business, you know, which we met a bunch of, you know, gnarly insurance characters along the way that have subsequently become like good friends. But, you know, he made me go out to dinner with him, his wife and my wife. He's like, I want to know that we're really getting business with each other. So, you know, Midtown Italian restaurant where we probably have way too many grappas and had like one of those chicken parms the size of this table, you know, but, yeah, we had a great run with the company. And, you know, when you make that type of money, like, you know, which I can't disclose the full amount that he made, but you're talking about an extremely lucrative outcome. You know, he calls me up and, you know, I'm like living in a 1-bedroom apartment in Chicago, like, you know, and, you know, barely affording my rent at this point. And he's like, hey, like, what color do you want? Like, and I was like, what are you talking about? He's like, oh, I'm at the Maserati dealership. Like, and I was like, what are you talking about, man? Like, I can't even afford the maintenance or insurance on that right now. Like, you know, like, and so then he calls me the next day. He's like at the Tiffany's, like, store. He's like, okay, what does your wife like? And he was just like, he's a very generous person in that regard, you know? So, instead, He invested in our first fund. Yeah. And he actually became one of the first investors in Archer Aviation that he met those guys at a dinner that we were hosting for our founders. So I think Kabir's made like 15, 20 million bucks off that. So like, I guess like the rich keep on getting richer. Kabir's done very, very well for himself since. He's a founder. I'm an angel in his company. But he's a character. And I think like, that's a relationship that, had we brought other investors in or blocked that outcome, I know his kids, Declan and Zeta, like you wouldn't be able to have what they have today had a different set of funding scenarios happen that blocked him into a corner, not enabled him to sell when the time was right for the company. And meanwhile, like we've had a very productive relationship. We recycled that insight into, 3Flow has a lot of adjacencies to Riskmatch as a business.
That's his new company, right?
Different. Actually, the first investment we made in Equal One, we basically took that insight and said, hey, I want to do this with employee benefits. Went to a bunch of the Riskmatch customers and said, hey, like if we found this business and did the same thing in employee benefits, would you guys be interested? And they're like, yeah, sure. So actually, one of the brokers that we worked with through Riskmatch sent me the company. It was formerly known as Watchtower Benefits. And these guys had never worked at a startup before. They had been around for 3-4 years. The company was flat. And the CEO, I believe he still has up on his wall a note that he got from a local VC in Chicago that says he had signed up for office hours. And the VC responded back saying, we are not interested in funding your company. Please stop signing up for office hours. And so,
that's crazy.
So, we engaged with Ryan, the CEO. Company ultimately pivoted from a SaaS model to the model that we implemented at Riskmatch, and it's just been absolutely gangbusters. So we led the seed, Emergence led the A, Excel led the B, Emergence led the C. We've plowed into every single round of the company, and it's been a really, really great story. Kabir's certainly been extremely helpful along the way. And Kabir's also one of those folks that as we've met a bunch of these brokers, now some of them are LPs in our fund, and they all came from that initial core relationship that we had into...
That you didn't block the sale of this measly...
A, we never had blocking rights to begin with, but I think, we think about some of these founder journeys of, Brad and Adam from Vettery or, Kabir from, Riskmatch. I was texting with Kabir yesterday because he introduced me to the CEO of a $60 billion insurance private equity fund. And he was like, oh, he wants to speak at your insurance capital summit thing. And I'm like, that's pretty cool. Like a $60 billion fund. Like how many $60 billion venture funds are out there? Like you probably haven't even heard of this fund in private equity. But I think that's actually the pretty interesting thing. Like that these guys can throw around a lot of money, have a ton of customers, and, having one great relationship there can, tee up a bunch of other great relationships that thinking about the long game, like you can do that when you're an emerging manager and say, okay, this is still a great outcome for us. Like it doesn't matter that it's not putting $200 million into our fund. This is going to be a 20-year relationship with this founder. And you know what? I'll get him on the next one. And if Brett and Adam decide to start another company, I'm not going to make the same mistake a third time. Like I'm going to give them a check. I'm sure it's going to be expensive.
Not one of the theses, one of the 4 theses, but
now my last 2 investments are founders that I've worked with in the past. One, his first company was worth $1 billion. His second one sold for 9 figures. The last one, his last company is a multi-billion-dollar company. And now they're coming back to the well and saying like, okay, like you did things right for us. And that's the fun part of this is like, there's not many advantages to getting old, but like that is one of them that you're like, I'm the only one left from, everyone else is so rich that they're gone. Like, I'm your only person that you worked with before. So, I got that going for me.
Okay. So I think one really interesting thing you mentioned, you mentioned this fund Light Bank that you worked at back in Chicago. You almost started a venture fund back when you were in Chicago. Like, tell me about that.
So it was actually before Chicago, like in business school, we, for those who remember Mike Rothenberg, like he was like the young wonderkin starting a fund. Me and the co-president of the Columbia Private Equity Venture Capital Club, this guy, Patrick Chang, he had worked in venture and private equity before school. Honestly, a better investor, a great person. We were, best friends in business school. We're like, you know what? We're going to start the East Coast version of this, like all focused on enterprise. Like, let's get this going. And we had structured all the programming that we had done around Columbia, when we were there on like recruiting the firm founders. And so I've long been very obsessed with, how could you do venture differently? How could you do private equity differently? That concept of being a entrepreneur as a GP, was something that I was always interested in. And we, decided, hey, like we're going to give this a shot. Partially because like we weren't getting enough like offers. No one wanted to hire us, so
this
like
is the classic, just like college, like I'm going to start my own
I'm going to start my own thing because no one will hire me.
Yep.
Like, and I was like, okay, like I've worked at a couple, I'd done some interning at First Round and at Bowery Capital and Foundation. And this guy had some more experience and I'd done some private equity. We were like, yeah, we can pull together a $10 million fund. And legitimately, like, that may have been my only option. Like I was still waiting to hear back on a lot of stuff. So we gave it like a real good go. We actually recruited a third person that we were going to do this with, Shruti Gandhi, who now, ironically enough, like it didn't work out. We had no ability to raise money. We would have completely failed. But all three of us independently have different funds now. So Shruti runs Array Ventures. Yeah. Like, Patrick runs Dispersion Capital, which is like this incredibly high performing, like, crypto blockchain fund. Again, stuff that I know nothing about. And then we have, the weakest of the three with Equal Ventures, but that concept of, okay, look, I think there's going to be a new class. I think that there's a lot of people from the legacy world that view the world very differently from me. I think they come from different pedigrees from me. And, I need to go and find a way to forge my own path. That is the way that I'm going to invest. And I'm glad that it didn't work out then because I think all three of us are better off. Patrick and I would probably not be friends had we started that fund together. And like, meanwhile, like his wife and two kids are coming over this weekend. So
nice. And then you did end up starting Equal. How did that end up coming about? What was the thesis?
Yeah. So a big part of the reason why I joined Lightbank was this point of view that, like, if I went to a traditional West Coast venture firm, I was going to get my ass kicked. And, that's because you had all these folks who were deeply technical that could, like, jam with, the top engineers coming out of some PhD program at Stanford. They had a bunch of friends from, Facebook or Uber or whatever hot company was. They had a deep network of CIs, CTOs. Like, that was not me. I was not going to beat Alfred Lin on, like, the next hot enterprise IT company that was out there. So I spent some time with my mentors and spent some time with other investors to figure out, okay, like what is my strategy going to be? And very much, I had a belief that technology was going to start impacting these industries like energy. First angel investment I made was RigUp, raised a couple $100 million valued at $3 billion, from Founders Fund, Andreessen Bally Gifford, and a bunch of other folks, that investing in companies like that were going to transform these $1 trillion industries was actually a much better fit for me because I came from consulting and private equity, you could call it my network, and the technology was pretty light. So I joined Lightbank on this, premise that, hey, I'm going to be in Chicago. These guys are actually investing in a lot of vertical software, building businesses that, aren't, research coming out of a lab, but rather companies like Echo Global, a tech-enabled freight broker that my boss had started, or Groupon or something else like that. More business model innovation than technology innovation. So, while there, I very much realized that the process of me backing those founders, companies like, Project 44 or ClearCover or RegUp, was very, very different for those founders who, all those were first-time founders. They were folks who didn't go to Stanford or one of those schools. None of those companies were, in the Bay Area.
They probably didn't look like a down the fairway for just a traditional
Definitely not down
fund.
the fairway. And if you look at the questions that they would get when they were trying to raise their seed rounds, it's like explaining insurance 101 or explaining oil and gas 101. And then the founders have to explain, like, you can't do oil and gas development the way that Uber worked. Like literally you will go to jail. And same thing with insurance. So with that process, it was very clear that, the experience that most founders were getting, if you were starting the next version of Datadog, you could walk into, Sand Hill Road or now South Park.
There's probably like 1,000 funds today.
Yeah. And they're like, oh yeah, like I know 10 people who work there and like I know this and I know a ton of customers that I can put you in touch with. And I've done my market map and I understand this and I understand this. They share passion for that space too, but they also have a prepared mind on that space. And they wouldn't call it a prepared mind, but they know enterprise IT left and right. If it's a consumer investor, they know every single consumer app out there and they know like the things that they're looking for. Meanwhile, when it came to looking at a business in energy, logistics, or insurance, it was like, hey, can you explain this to me? And can you put me in touch with a customer that I can call because I don't know anyone who runs warehouses. I don't know truck drivers.
I haven't read a blog post on energy.
It's like, do you have any McKinsey reports that you can send me? Like, stuff like that. So, the reality is they didn't have a prepared mind for that. So the premise of Equal is very simple. It was, if you believe that we're going from this age of developing technology to deploying it across these big markets, which vertical software was still a little bit of a contrarian take. Viva was really the first big win, and Viva was not a big win at that point. But companies like Viva and Guidewire were really starting to pop up and become big companies. If you believe that was going to be the case, how could we lean in on that and bring a prepared mind experience to those founders the way that consumer and enterprise IT founders, had, prepared mind from their investors? So really, we bet big on that and said, okay, the only way to do this is to lead checks from day one, because we need to be able to price these rounds. Otherwise, these companies are not going to get, fundraising, and really focusing on what are the markets that we think have enough catalysts that we think that there's going to be economic turnover, enough complexity that we think that we have advantage in there, enough of a connection to those markets, that, we feel like we can actually be helpful, candidly, low enough competition that we felt like we could have a pole position. I'm not going to go jump into healthcare or fintech, or prop tech, knowing how many investors are already in those waters. So we picked a couple of markets that we knew people that were super complicated, that had a bunch of catalysts driving them, and raised $55 million to go prove out that thesis.
And was it super simple? You just sent a couple emails and texted some friends and you raised $55 million, or how did it go? What was the process?
Worst experience ever. Okay. So I think the whole process basically took, 18 months, 2 years. Slept on couches, slept in hostels. Literally the night before our IC with who ultimately ended up being our anchor, we slept in a hostel. I had I want to say 3-week-old daughter, my first, at home. So, if you want to find a way to piss off your wife, it's leaving, a newborn at home. The only sympathy I got that was hey, it's not like I'm playing up at the Ritz. I'm staying at Fieldhouse Jones, in a pretty crappy place. So as you look at that dynamic, I had a really solid track record. I think I did 11 investments at my prior firm as either, for a fund or as an angel. 4 of those ended up becoming unicorns, a couple other 9-figure exits. I thought it was going to be a lot easier. I had a bunch of people encouraging me to go out, and then it was just a total brick wall.
So what was the brick wall? What were you doing wrong?
Well, I still think till today, and moving forward, we are terrible at pitching our business, but I think there's such a focus on where you worked, what your pedigree is, how connected you are, which I had LPs being how can you prove that these numbers are real? And I'm go talk to Lightbank. Did Eric and Brad do those deals? It was just a level scrutiny that I would say is very fundamentally different than had I, come out of NEA or, General Catalyst or Lightspeed. That candidly, one of my good friends from business school who's an LP was hey, why don't you go and take a job at a marquee fund? I had a job offer from, one of those marquee funds. He said, go work there for 2 years. And then this will be a 10x easier experience. And personally, I didn't feel like I could do that. There were 2 reasons why. One, I felt the ability to do the deals that I wanted to do within those partnerships was not going to work.
Because you weren't going to convince hey, let's do this insurance. Insurance is not a category anyone's investing
I won't say the name, but a firm that offered me a job, again, some pretty scaled companies said, hey, do you ever think these companies will move the needle for our fund? And I'm if a $3 billion company is not moving the needle for your fund, then especially when I invested at a single digit valuation, then I don't know what is going to move the needle for your fund. But explaining and actually recognizing that the product experience that those firms were used to was just so different than what we wanted to provide, that they wanted more enterprise IT. They wanted consumer founders. They wanted the things that they were used to investing, that I would have been a fish out of water there. But then secondarily, if you're leaving a fund and you're going to leave there, writing that check to a founder and saying, hey, I want to go take your board, we're going to be in this for the 10-year journey. I'm just a really bad liar. That I don't think I could have sold that to founders, and I probably would have gone 2 years not investing and just making a paycheck and being out of the investment game, because I would have felt really uncomfortable taking a board seat, leading investments, knowing that I was going to leave. That's not exactly the case of what I'm seeing at some of these firms, that like the junior partners know that they're going to leave and they're like still willing to sling checks. But
there's kind of this exodus maybe happening. Like, what are you seeing right now with partners
it's
at these
terrible.
funds?
We had someone try to preempt one of our companies. Literally a month later, I heard from an LP that like, hey, that person's raising a fund. What do you think? And, I had heard rumblings that person was thinking about raising a fund, and which is the reason why we shut down that process. But man, like if that person had led investment and then left a month later, like that probably would have killed one of our companies. And again, like we own 17, 18% of these companies. They're meaningfully impactful for us. We have 15 companies per fund.
I was going to say it's pretty concentrated.
So if we lose one, it's a big deal. We've only had one company die in the history of Equal, and like we focus on making sure that we have a very low loss ratio, for better or worse. So as I look at that, I think there's a lot of these dynamics that like if you're going to be an emerging manager, like this has got to be your last job that you're ever going to have. And for better or worse, that's our mentality. I tell founders like, I have a relationship with every single founder in the Equal portfolio, regardless of whether I'm on the board or not, that, from here on out, if, you're going to have your deal sponsor here because ultimately I'm standing behind your deal alongside our product owners and generalists. So,
yeah. So you mentioned like your first ever pitch to a big, institutional LP. You thought you're going in, like my track record looks pretty good. How did it go?
Horrible. So like I had a friend who I interned with in business school. She was at another fund and she worked at that LP at the time, and she set me up with it. Like,
so it was like her boss's kind of,
her boss was like, and she really like got on the soapbox and was like, I've known this person for forever. I backed them blindly. I want to invest in their fund. You got to go take the meeting. And then like immediately, like 5 minutes after the meeting, like I'm like hearing how bad the CRM notes are, that it's like, Rick, like, what did you guys do? Like, the pitch doesn't make sense. Like the team composition doesn't make sense. What's the thesis behind this? Like, it's just bad. Like, little things that you wouldn't even think of. Like, wait, why haven't they changed their LinkedIn profiles yet? Why isn't their website up yet? Like their logo, it doesn't look like it was professionally done because I made it in PowerPoint at the time. Like, probably still would, So like all these little kind of things that like, no discussion of track records or whatever. It was just like pitch doesn't make sense, not articulate, all these other things that are really perception bias rather than actually like looking at the objective, data behind it, unfortunately. But it was so bad that my friend was like, you need to shut down your process right now and figure your shit out. And so like we took some time after that to like really hunker down and figure out what our pitch was.
So what did you change? How was it different from maybe that first attempt to like what finally was landing with people?
To be honest, the only thing that really made it land, I think, is people seeing enough work around the process, which like when we went to ultimately who anchored our fund, we were bringing multiple markups already into that fund of like what were positions that we had like big ownership in. And like, we showed up for our IC, and we had already had a 2x markup on 3 flow from Emergence Capital on that. So bringing that and, the markup from Cosino that we had on Leap, and, we had this markup on Block Renovations, which was an angel deal that we, warehoused in the fund from NEA, and, Kleiner Perkins had marked up, our investment in Pattern Brands. So we were, demonstrating a little bit of a track record, but I think like actually showing the process of like, hey, here's how we do research. Here's a non-consensus opportunity. Here's how this deal came in via like a, insurance broker that I've known for like 6 years. Here's this non-consensus thing that we found. The numbers don't make sense, but like, here's our approach to it. And now Emergence is coming in 2Xing it. I think got some conviction on.
You kind of like bootstrapped or backed into that like social signaling of like, oh, I know all these other good funds and you're getting in earlier before they are.
Well, I don't even think it was social signaling. I think it was like legitimately, had we not had a bunch of markups that people were looking at this fund and saying like, all right, like I'm getting into a fund at cost when it's already marked up like 2.5, 3x. Like that helped a lot of people get there. I don't think that's what gave our anchors conviction. I think our anchor said, okay, while you are terrible at articulating what you do, I can kind of see it given that like I saw this process that you did with a company like 3Flow or an incubating Leap, that you go through this long thesis generation process around markets that you know really, really well. You stack the deck with a bunch of customers that you know to kind of reduce the risk along the way. And that enables those folks to better articulate their stories and raise subsequent rounds. I think we've become slightly better about, you know, showing people what we do, you know, but the reality is like, we're not an Uber for X story. I think there's plenty of, you know, venture firms that have, you know, a verb about them. And one LP was like, hey, like you need to, you know, think about yourself of like Union Square Ventures is about network effects, like, which I think USV would probably push back on today. But that's like, hey, we're a lot more than network effects. We think about things more broadly than that. But hey, first round is about platform, and probably first round would push back against that today. So I think a lot of LPs want to put you in a box early and say like, hey, here's the reason why like you're special. It's, hey, like you're a media entity, or like, hey, you have this huge, you know, founder network that you have, or, you know, here's this XYZ, or you worked at, you know, a buzzy fund that, you know, has, and I think that's what LPs want to see. If you do not fit in one of those boxes, the process is always going to be incredibly painful. And unfortunately, like incredibly unfair, because I do find that the managers that I've, you know, I'm an LP in several funds, to be honest, like the ones that have performed the best come from the most obscure backgrounds. And they're folks who like didn't go to the top tier funds, and they're just like dogs. They just keep on getting back up, like, and they're, you know, they have unique deal flow. And when I look at some of those, I was like, that was a non-consensus fund and right. And they were often funds that LPs were like, I won't even take the meeting. And versus like some of the other ones I'm in, like LPs love them. And then the returns are, you know, look, we'll see what happens in 10 years, but like not matriculating as fast as some of those other ones.
Yeah. And then I think you do this really cool thing that I feel like I've gotten to know you a little bit better through this EMC summit that you do. Can you explain that to us, what the whole group is? And then
So basically, when we were starting Equal, I had this cush deal with, you know, some real estate guys that I was with who let me work in their space for free. Okay. And with that, you know, I was able, you know, this gorgeous space in Chelsea, hosted because I couldn't afford Kaufman, you know, brought in a bunch of other emerging managers.
That's why you did it?
Oh yeah, 100%.
I didn't know this.
It was literally like me, because like I couldn't afford Kaufman, getting a bunch of other emerging managers. Like it was like 8 of us originally, all starting firms in New York around the same time. Great crew of folks, in person once a month. And basically like talking about how shitty our lives were, like raising money and like how hard it was to be, but just actually having a safe space that you could be like, okay, like I'm dealing with this issue, or like, hey, has anyone dealt with this LP? Or like, hey, I have to take a markdown on this investment, or hey, this, you know, lawyer's overcharging me like crazy. Like, what should I do? And like us drinking wine and eating pizza and, you know, lamenting and having, you know, brotherhood and sisterhood in our torment. And then every session, someone asks like for another person to join, be like, hey, you know, Addie Lerner is starting a fund, or, you know, Chris Paik is, you know, starting a fund, or XYZ. So we'd start like looping more into the group over time. And that was a lot of fun. And then, you know, I was able to get some of these GPs and LPs to come speak to. So we have like Josh Koppelman come and speak to the group, and Roger Ehrenberg come and speak to the group, and, you know, talk about their founding story. And I thought that was really, you know, cool experience. And then a bunch of LPs, you know, from Greenspring or Accolade or, you know, UChicago or whatever, come and meet the group. And that was cool. Then COVID happened, and it was like, okay, so that group's dead. Like, you know, like,
you thought it was going to be?
Oh yeah, 100%. Yeah. And then, but I think, you know, at that point we had sprung up like a Slack group, and a bunch of people were like asking like, hey, what are you guys doing? Like, you know, are your LPs defaulting? Like back in mid-March, which again, we launched our fund. I think our announcement date was March 5th of 2020, which like.
This is Equal Fund 1.
Yeah.
And you had closed it?
So yeah, we closed it in basically Q4, like, you know, like, or at least had commitments, and then like formally closed it in Q1, you know, tried to line up everything for an announcement, paid a PR firm, and then I was like, well, that didn't work out. You know, but, you know, everyone kind of asked, hey, like, what are you doing? So I got together a couple LPs for a Zoom session, you know, to speak off the record about, you know, everything. And then a bunch of West Coast folks wanted to join in. And I think we had like 60, 70 GPs show up for that like session. And then, you know, look, during COVID, all of us, especially emerging managers, like we were looking for a lot of answers and we were looking for camaraderie. Like, my employees could not understand the experience that I was going through, as well as, John Laird from Workbench or, Nick Charles for Notation or, someone else who's running a fund being like, hey, like, how am I going to go fundraise if I can't meet LPs? Or how am I going to engage in Porter? How am I going to handle my employees in a situation that like we're trying to do this remotely? Like we were trying to figure a lot of things net new for the first time. And so we started doing monthly sessions with GPs, LPs. I did a session with Jerry Colonna, like from Reboot in front of everyone in the group where he's like, who thinks I can make Rick cry in the first 5 minutes? And like, I will not respond to whether I did or didn't.
This is on Zoom?
Yeah. In front of 120 GPs.
I'm trying to remember if I was in that one. I don't remember.
Yeah. So like, I thought that was like a very important thing to get me through COVID. I had no childcare help during COVID. My wife's a real estate private equity investor. We had a 1-year-old, daughter. We were living in the middle of nowhere with, our in-laws. My mother-in-law was going through recovering from pancreatic cancer. It was a hard time. And so, the reality is having that group meant a lot to me, that when I came out of COVID, it just was like, how can I give back to this group and how can I make sure that I spend more time with these folks that have given so much to me and helped me get through like what I would consider one of the hardest times of my life. And with that, one of my LPs hosted this summit in Jackson Hole and it was awesome. Like I definitely did not deserve to go. Everyone there was 10 times like more impressive than I did, but it didn't feel like a conference. It was like, it felt so intimate. Like it felt like you could actually have real conversations. It felt like an anti-summit. And that's the reason why we deliberately use summit, like in the words that
instead of conference.
Yeah. Because I want it to feel like actually you're like getting together with friends, that like you can actually have real conversations and, not be accosted by 50,000 different vendors and not have to go and like, pay a ton of money, which like, every emerging manager is broke, even if they're projecting that they're wealthy. They are broke as hell. Like, and so, just making it easy on everyone that like, and then solving for some of these power dynamics, which like I've been to conferences where, the balance of GPs to LPs is like 10-1. And then you have a guy from Utimco off in the corner with like a bunch of $5 million funds around him. And like the reality is that's a shitty experience for both of them. Like Utimco couldn't merge all those funds together and write a check small enough to like meet their needs, and the reality is like they're looking for someone who can write a $250 to $500K check, not a $50 million check. But when you balance that power out and actually, have GPs equal to LPs, you can find people and everyone's much more relaxed. And because it's off the record and no media, like I felt we could have real conversations and, each year we've had a Midas Lister cry, like, which I think is like, hey, like, me getting billionaires to cry is like, I sound more and more like a hedge fund guy when I say that, but I do think that is like, where else are you going to see people share that type of stuff, which is pretty cool. So it's been an important thing to me. And, every LP asked why I do it. And I said like, if we're going to have hobbies, like that might as well be one. That's a better hobby than like, me, like
there's worse hobbies.
There's certainly worse hobbies that I could have.
So. Yeah. How does it work? How do I get invited if I'm not like somebody on the, like, is there an email list? Is there a website? Is there like, you've talked with the Slack group?
There is a website. If you know someone in the group, that's the best way to get in.
Okay.
So like, we do have an application for the group and we have an application for the summit. So we do not market the summit broadly, and you can't buy a ticket. So the only way to get in is if you're part of the group.
Yeah, you always tell me like invite only, like do not add people. Like there's a wait list. Like
so I think we had about 1,500 people apply for what were 150 GP slots last year. We had about 350 LPs apply for what were about 150 LP spots. We like to keep that 1-to-1. And I just think like, we never have any desire to make it big. Like I'm not an event promoter. I'm not trying to like make money on a conference. Tickets are free and it's just, yeah. So every event that we do is free. I think that's important to make sure that like we're not profiteering off this. Like it is an investment that we are making as a firm in building stronger communities. We do the same thing in climate. We had 5,000 people apply for a climate capital summit. We let 350 attend. We had $1 trillion of capital on stage, while we were there, and CEOs of $100 billion worth of company. We're doing that in insurance. I think we'll have like 250 billion of insurance private equity, like on stage, couple, probably 100 billion of CEOs as well. We're going to do it in commerce, then we'll do our climate capital again. So I'm gradually becoming an event promoter, even though I don't want to be. But I do think in person, especially post-COVID, just like in real life experiences, especially when it's intimate, like it doesn't feel like, a sales pitch, that you can actually, an introvert like me can actually have a real conversation and get to know someone. I really value those things.
Yeah, I feel like there's almost this room for, to your point of conference for summit. Like there's a lot of conferences out there. There's a lot of conferences I maybe go to where I just felt like it wasn't worth it.
Yeah.
But I like the EMC. I think I've gone to every one since.
So I'm like
post-COVID.
a total natural introvert, and no one believes me. Like in that, like I go to one of these conferences and it's like 5,000 people. I'm like,
I like the opposite
this is too much.
Of command a room. Like,
I'm like put my AirPods in, like go to my computer and like wait for someone I see. Like that's more my style.
Yep.
Despite me seeming more verbose than I am.
Yeah. Well, this has been a lot of fun. Thanks for taking the time to do this. I think this is
Love it, man. Thanks for having me.
And thank you for listening. If you missed it, make sure to check out last week's episode with Billy Ilchev on his journey building category ventures from a legal immigrant to raising his $160 million Fund 1. If you like this episode, please leave a quick review or comment wherever you're listening or watching. Check the show notes for more on the topics mentioned throughout the conversation. And if you don't want to miss a future episode, subscribe to my newsletter, The Split, to get each episode plus a transcript emailed directly to your inbox every week. Thanks for listening. See you in the next episode.